Island reversal. In stock trading and technical analysis, an island reversal is a candlestick pattern with compact trading activity within a range of prices, separated from the move preceding it. This separation is said to be caused by an exhaustion gap, and the subsequent move in the opposite direction occurs as a result of a breakaway gap. Formation. Close scrutiny of island reversal formations shows that the island reversal consists of an exhaustion gap and the subsequent move is followed by a breakaway gap. Uncommonly, the breakaway gap that completes the island is filled in a few days by a pullback as a result of the reaction. The island reversal can occur also, inversely, at the peak or the reverse of head and shoulders formations. For example, assume that the price in a rising trend closes at its high of $84 and opens at $86 the following day and then does not fall below its opening. Near the end of the day, it moves up further and touches $88 but closes at $87.60 however. Observation thus shows a gap of $2 which is not filled. On the following day market price open at $87.40, touches high of $88.90 and closes at $87. A few days later or the very next day, market price opens at $84 and closes at $82.90, keeping itself below the area of $86 and $84. All the trading above $86 will appear on the technical analysis chart to be isolated and is known as an island reversal. An example of a bearish island reversal pattern was identified by Kenneth Grunason and published via Counsel.net when ITT Educational Services, ESI, topped in January 2009. SE fell from $120 to $12 in the 4 years that followed. https://web.archive.org/web/20508631/http://premium.cancelim.net/cs/news/templates/openarchives.asp. A = 16266. Characteristics.